And without further ado, Zarko Walden, round of applause, please.
Thanks so much, Sumit. My name is Zarko Maletin, and I'm with the Plug and Play Ventures, which is the department of the Plug and Play in charge of putting the startups from our community in touch with the investors and corporate partners. So it's all about all around around about 180 VC firms that we are working with, around about 100 large-scale high-tech corporations that we are working with, and around about 350 angels, including all the angel groups from the Valley. I would like also to thank all of our judges who are our guests today here. We have around about 90 judges, out of which 2/3 are VC firms, and the rest are corporations looking for either business development, acquisition, or investment opportunities with the Plug and Play. And altogether, we are thankful for your cooperation for the last 4.5 years. Today, we are going to have a special opportunity of meeting 3 exquisite investors, our friends, our old friends, and some of them are investing in our startups as well. In the first place, I would like to introduce you to Josh Goldman. Josh Goldman is with the Norwest Venture Partners. He's consumer-facing internet guy there and also involved in the services such as search, e-commerce, etc. Josh, why don't you join us? Josh is also at the board seat with Snapfinger, Luminosity, Quirky, Whale Shark Media, etc., and also observer at advisory boards with Retrievo, Drivewire, which are basically today with us. Retrievo is also one of our companies. Thanks so much, Josh, for joining us.
Thank you.
Josh is also one of the most early adopters when it comes to high-tech gadgets in the Valley, and if you need more tips about Tesla motors, etc., he's one of the drivers, so you can talk to him on the break. At the same time, I would like to host and welcome Rob Theis from Scale Venture Partners. Rob is their technology, infrastructure, and application software guy, also interested in working on internet and cloud stuff. Used to be a general partner with Dole Capital Management. Used to work with New Era Networks and Neon, where he actually led the company to 300 million revenues and helped with the successful IPO. Rob is as well a mountain rescue specialist and rescue diver. So if you're enjoying the outdoors, you may meet him at one of these locations soon. Rob, please, why don't you join us? Thank you so much. And I would like to also welcome Matt Miller. Matt Miller is with Walden Capital and also recently investor in one of our startups with Arki. Matt focuses on early stage companies as the rest of his partners in the firm are. He's also a cloud software guy since he started his first software program in the 70s. For the last 23 years, he has been actually 20 years, he has been deeply involved in the early stage startups and responsible for the Walden successful exits with Niku and also currently director at Power Cloud Systems, Image Vision Labs, and others. Yeah, Matt is also a vivid golf player and collector of baseball equipment for Boston Red Sox and San Francisco Giants.
Yes, sir.
Thanks so much. Without further ado, we can start with the panel. This is a pretty open panel. We're going to have a couple of open questions. In the first place, when it comes to the recent developments in the Valley, the second quarter of 2011 was actually looking well. The third quarter seems, a lot of people have mixed feelings about it. In the first place, when it comes to investments altogether in the US, seems to be 8.4 billion investments made in 765 deals, which is actually an increase from 8 billion in the second quarter. And at the same time, the fundraised capital from the side of the VCs has dropped from 8 billion in the second quarter to 2.2 billion. So there seems to be, in the first place, the decrease in the fundraised capital from the side of the VCs. And it seems that the role of the angels, especially super angels, has increased in the last year, as we know. The last couple of quarters, when it comes to the angel groups and individuals, so non-super angels seems to be dropped as well, but the involvement of the venture capital within the corporations, the corporate venture arm seems to be increasing. And I wanted to ask to discuss a little bit about that issue and where exactly the venture capital industry is going.
Well, I'm not sure any of us know exactly where it's going, but I could make some comments on what you just started with. I've been in venture now for over 10 years, and I spent the 20 previous doing startups and some bigger tech companies. I think this is a really unique time in the environment. You've got a bunch of these dynamics at work at the same time. Let's be honest, the number of venture firms has been shrinking the last 5 years anyway. It peaked out in 2000. It's been dropping since. The amount of money going into venture has also been dropping for the last, I don't know, 5, 7 years anyway. And yet the amount going into young companies, if you look at the lines, has not been that different. There's been this big drop-off in money into venture, modest only drop in money going out. Difference in sectors, obviously, more in consumer now, more in mobile. Never used to happen when I came here in the 80s, didn't exist. But that dynamic makes it really interesting for entrepreneurs. There's more seed money now than I've ever seen in my life. And I often have the impression it's easier to raise $200,000, $300,000 for your first round than it may be to raise your A, which had never been the case in the Valley before. A lot of the firms, when I started in the Valley in the 80s, that did the early rounds, they all got really successful and got really big. And then it became harder to raise the $2 million, $4 million Series A. Yet in the past 5 years, I don't know exactly why, but the upswing in seed has just been incredible. It's as if all my friends somehow retired and became angels, and they're doing more deals than I would have ever imagined. So all this put together creates a huge bunch of new, what we call sprouts. We invade what we call the sprout stage of a company. When there's a demo, a finished product, some early customers, that's what gets us excited. That's when we invest. It's been great for us. There's a lot of that. But we have to be really careful, because when it comes time to raise the B, it's certainly not as easy as it used to be, not that it was ever easy.
Yeah, I think it's a good point. It's worth recognizing that companies today take so much less capital to get to a point of having a widespread consumer or customer base. When I think most of us started in the business, either as entrepreneurs or as investors, the first thing startups did would go acquire a whole bunch of Dell servers or NetApp boxes to host their service on. And that was often a six-figure investment or even more. And nowadays, the people making startups look at you like you're crazy. Why would anyone want to buy server hardware? Because you tend to rent that. You buy that and use it on demand. That alone changes the dynamics of how startups get funded, and it's changed the way the venture capital industry works. I think companies need less over time to get to any particular milestone you want to pick. First revenue, profitability, their product line being mature than ever. Therefore, you'll see a lot of venture firms either making relationships with the super angels or starting to move earlier in the venture cycle. Because if you don't find and work with these companies at the very beginning when they only need a couple $100,000, you may not even get the chance to invest in those bigger later rounds. So you see a lot of the venture firms trying to move earlier, even if they're large funds. Our fund is $1.2 billion. Most people would say, at least 5 years ago, with that size fund, you can't be investing $500,000 at a time. And we do. And the reason we do, and the way we explain it to our limited, is that we do it because it's sort of table stakes to get access to the best crop of entrepreneurs, which is why we're active here at Plug and Play and other investor forums like this and incubator or co-office environments where you find a lot of these great new entrepreneurs.
Well, I can't say much more beyond what these other two have said, but what's interesting about the venture business and startups in general is the business ebbs and flows, right? So in the downturn, you'll have issues, and in an upturn you have issues. One of the things that's at least a common characteristic of venture guys like us is we complain and bitch. When it's high, the valuation's too high. We can't get a deal done, right? When the market is in the toilet, when the world is about to collapse, we can't do deals, right? But the interesting situation, the reality of it is every market downturn, that if you look at the last 20 years, there are great companies that get formed at every single point in time. There's never been a shortage of capital. And when people think that they can't be investing or innovation has stopped, that's not true. You take a look at some of the most recent companies, even Groupon, right, that it was an innovation of just a byproduct of the recent market downturn. If you look at after 9/11, the recent market downturn, there was a huge set of companies that have continued to get created there. And then is the inflow of capital. It comes in many different ways. As you mentioned, you've got corporate ventures that are coming back into the marketplace today. So that, that doesn't create a lack of capital. And then, the angels and super angels, there's, bless their heart, because the reason they're investing is they're successful at the age of 25 and 26. If you just count back 11, 12 years, they were only 15, 16 years old at the last dot-com bubble, right? And they did not remember that, and that's why this valley is so wonderful. So, when people say there's lack of capital, I don't think so. And then what Josh mentioned is today, it's amazing what you could do in terms of what you're able to start a company, right? So you take out your credit card, you can get time on Amazon. Open source. Tools are virtually free. I mean, one of the companies I did help get started in an early stage company was Tapulous. Right, so they basically, they raised 1.8 million in angel funding. They used less than 500,000 of that before they grew. And again, the resources and what's available is just very vast and very different, and the economics have changed substantially from the last 10 years.
Thanks so much. When it comes to the developments in the valley in general, on the side of the startups, what a venture capital is looking for, and we all know that the descriptions of the objectives and investment objectives of the VCs on the websites is something completely different from what the investors eventually invest in, which is okay. But then again, what is it that you feel that is developing the valley recently, and that could be interesting for our startups to learn about? Starting from push commerce or collaborative consumption, what is it that you would like to share with our community?
I'll take the first crack at that. I focus on e-commerce as the bulk of what I tend to look at and invest in, and it's really an amazing time in the e-commerce space. There are a lot of new models and far more capital efficient models for connecting buyers and sellers, for selling products directly to consumers. And the things we worried about 10 years ago in e-commerce, phrases like channel conflict, have pretty much disappeared for the most part. And there are new models. E-commerce is very trendy. A couple of years ago it was flash sales. Last year it was deal sites and deal of the day. And I would say this year we're seeing two big phenomena. One is subscription commerce, where you sign up for a particular type of service like shoes or clothing or food, and you get a delivery every month. And you can return stuff you don't like, but it comes automatically. And it's curated, selected for you based on what you said you liked and what you've returned in the past. Very powerful models. Companies like Beach Mint and Shoe Dazzle and others are in that space. So that's a big new trend that has investors tripping over themselves to fund subscription commerce models. And then collaborative consumption that Zarko mentioned is a phrase being applied to companies like Airbnb. And the other phrase you'll hear is access over ownership, where you, very much like we treat servers. We talked about how startups use servers. The same attitude has given rise to things like, well, why shouldn't we share use of a car? And when you need a car, you see who's got one that they're not using. When you need a place to stay, you look for someone who's got a spare room in their house. When you need office space, you look for companies that have listed extra conference rooms in an exchange. So really exciting new companies being born in that space too. I think those are some of the most powerful trends I'm seeing in e-commerce.
Well, I'll give you a few that are maybe business model related. I'm an IT guy. I came out here to work for Oracle in '88 and I stayed. And I really did IT and software my whole career. But our firm has been very successful also in digital media. We were the first investors in Pandora and also in SoundHound, which was a plug-and-play company. Now, I'm going to say this is almost unfair, but what's exciting to me is people are starting to believe, anyway, that you can apply the models of Pandora, which is a company that spent, by the way, almost nothing on marketing and did 1.8 billion hours last quarter in streaming. This is the oft-talked about, seldom-seen viral model. Well, what's exciting is people are now getting somewhere, I'm not sure exactly where, in the enterprise with this overused term of consumerization of the enterprise, freemium models in the enterprise. You do have companies like Yammer and some others who are getting all their revenue from a very small subset of a very large N. And when I was at Oracle, it wasn't about getting a large N of billions of people using the Oracle database. We wanted only a few thousand paying us a lot of money. And that model is being flipped on its head right now. And I'm not going to tell you that I know that that's going to work, but it's exciting to see some of the scale we're seeing in some of the companies we meet. A company I'm trying to close an investment in now just launched a, quote, beta and ended up with 3,000 registered users from real companies running spend through it because it's free. Now, is that going to lead to a great outcome? I do not know. But it didn't used to happen, and it's pretty exciting, and it's one of the only ways I think that is easy to get jaded IT investors a little bit excited, is to be able to see this huge uptake by going direct to businesses with software on the internet. That was not possible when I started, and that's a different thing.
I think another way of looking at things, your question is, what do venture guys look for in entrepreneurs and so on and so forth? And there's two categories of entrepreneurs, as you well know. There are those that are seasoned, have done it before, and well known, and those, interestingly enough, have an easy way of getting funded because somebody will just back you or you've made money for them before. But there's a huge population of entrepreneurs, like many in this room here, that have never done it before, and that's not a reason why you can't make things happen and produce things. And generally, what we look for is traction, right? As a venture guy, even the angels and super angels, they want to see whatever you develop, whether it works or not. And if you develop something and it works, you get traction, you get usage, right? You get engagement time, whatever metric you want to apply to it, high likelihood you'll get funded, right? In many cases, what you may develop initially may not be what it will evolve to later on because you will make the appropriate adjustments as you go forward. But that's really what we look for. I mean, there are, what is challenging sometimes is what you develop is you see the initial growth and then it just plateaus. And then you kind of have to go figure it out, what to do from there. So there's going to be a point in time, an inflection, where you're either going to combine it with timing, right, with the initial growth, that you'll be able to get funded. And that's how entrepreneurs that are still in college or not as well known is able to get funded.
Thank you so much for that. And now when startups approach you and when they're ready to present their ideas, etc., and most of the participants today are startups, what is it that you're expecting from them? What is the approach that you would appreciate, and what is the information that you would like to see?
Well, I mean, again, it's a little bit of a takeoff what I just articulated, in that it's traction. But the thing that is most important when I look an entrepreneur in the eye is to see one, how passionate they are, but more importantly, how well do they know their business, right? And how well do they know their competition? And believe it or not, they may say, well, we're somewhat unique in this particular area, or maybe there's a couple of others. Help us by just helping you assess on what to do by telling us everything. Complete transparency is really good because we will find out all your competition, right, in that particular area. And if we figure out that you only know a subset and you haven't figured out how you're going to win against some of the others, that's not good. I mean, that's a really good element to have, is that transparency, the knowledge, the competition, how you're going to win against the other players. Because you're not going to want to spend, by the way, the next 3 to 4 or 5 years out of your life trying to go figure it out and not anticipate what everyone else is doing. You just got to be very self-aware.
I'll add a couple of tips to entrepreneurs for presenting to VCs. It is mostly true that your audience will have made up their mind about whether to invest or not, or at least to go to the next stage, in about 10 minutes. And it's really important that you get that passion that Rob talked about, that you show what the team can do, what you've done in the past and how that's relevant. And that needs to be handled very clearly. We've seen too many presentations where you're describing at length every member of the team's background for a half an hour, and the half an hour is gone out of an hour meeting. And that's not a good way to get started. I think another tip is just to understand the way VCs look at making investments. It comes down to risk and reward. And if you keep that in mind in your pitch, every time you show that the reward may be higher than that person may otherwise guess, size of market, tangential markets this could apply to, the willingness to pay in these markets, et cetera, that boosts the likelihood that they're going to invest. Every time there's a risk, you as entrepreneurs want to minimize, however you can, the extent of that risk. So you talk about the makeup of your team, how you've got the right people or advisors from the right background to make sure you're making the right decisions. Technology risk, business development and market risk, all of those things. But everything you're saying in those meetings is adding up to either a change in how we're thinking about the reward side, how big this could be as an investment, or in the risk, right? If you have no one from consumer internet and it's a consumer internet startup, the risk factor for us goes up dramatically. And that's something to understand, that trade-off when you're presenting to a VC.
I'll throw in two, I think, truisms about raising money. One is, it's always better to be different than to be better. And that sounds really stupid, and it did the first 100 times I heard it. But after you listen to 1,000 different pitches every year from investors, it's kind of amazing how they all blur together. So when you put yourself in an interesting market and you think you're making progress because you know it's a good market and we're all nodding our heads, all we're really doing is thinking of the 5 questions of, oh, so you're like those guys. Oh, so you're like these guys. You're like those guys. Once you get into that, it's a little bit of a death trap because you are like those guys if you're getting all those questions. So defining what you are in this few sentences, which I think is a little bit of what Josh was getting to, don't move on in a presentation until you do it and you feel like you've really got the core of it. Because even if I get it and I'm really, whatever we want to talk about, databases, tools, pick your infrastructure, I know it, I'm really good with that. I've still got to sell it to my partners. So a common mistake made in the fundraising business is, hey, he loves it, Matt loves it, it's going to be great because he just loves it. Well, I may love it, but if I can't dumb it down to a few sentences for my partners, then I play the same game with them. It's in this space. Oh, so they're like this, they're like that, they're like that. Well, we've seen those before. So better to be different. Pick something that just makes you sound completely different, and I'll be brief, but the second point is, we typically see companies that have done their seed round. Now they're trying to raise the A from Walden. We expect some numbers to dig into. It's not going to be sales numbers. Often it's consumer or it's beta numbers, but whatever numbers you've got, for God's sakes, try to make heads or tails out of them for us, because if you don't understand them, we don't. Unfortunately, we are in the business of extrapolating off of really small data sets, because that's kind of what we have to do in this A round. So whatever numbers you got, know them cold. When people come in and they start throwing out numbers and they don't know those numbers, and my partner says, okay, but what about active users? How do you define active users? You gave us total users. In the beta, how many active users? What did they do, in the next 2 weeks? Which is an obvious question, come on. And somebody says, well, gee, I really don't know. The meeting just took a real big bad turn. Or whenever the CEO says, well, I don't know, my CFO's not here. You're a startup. You are the CFO, you're the CEO, you're the sales guy, you're the product guy, you're everything. So it's better to be different than be better, and figure out how to extrapolate from a very small set of numbers in a useful way and really go deep in showing us you've analyzed those numbers deeply.
Can I jump in with one more tip? Also, I just remembered that is really important. Do your homework on the firm and the people that are going to be in the room. And you should also expect, by the way, that the audience, if you've supplied materials in advance, has done their homework. It's reasonable to expect that, but you may not always assume it. But it's surprising how many people come in and say, well, tell us about your firm and your portfolio. Are there any relevant portfolio companies? It's much more impressive when they know my background, what I invest in, it's all on our websites. I mean, it's public information, and they say, you did that deal with Quirky, or your investors in Jywire, and I think there's a great connection we could have with that company. And that shows us that this entrepreneur really cares about wanting to work with us, and they've done some homework on who we are, how we invest, what we've invested in. It's really important. It makes a great first impression.
Thank you so much. I think we can conclude our panel with this today. Thank you so much for coming.
All right.
Thank you.
Look forward to working with you.
All right. Thanks. That was short and sweet.
We can have 5 minutes of Q&A if so.
we're doing Q&A
A couple of
now.
minutes are left. I apologize.
Q&A.
This is-
leaving.
All right.
It's okay.
Any questions?
No questions. Oh, wow.
You can ask anything. We actually will answer.
Hi guys, my name is William. I'm from Gizmo.com. We're a Dave McClure 500 startup company, so this is actually really relevant to us. So with the advent of a lot of accelerators and incubators and all these things, how do you guys see the Series A crunch happening for a lot of these startups that are getting, the $300,000 or $200,000 investments, and then that's just enough money for them to fail?
Let me try to rephrase the question.
Yeah, because I'm sorry, I did not hear.
Try that one more time.
Louder?
Yeah.
Okay.
Can you just?
I'll
One more time with feeling.
Yes. So what I was saying was, we're part of an accelerator, we're part of an incubator, and a lot of our counterparts are getting funded, say 300 grand, 400 grand, 200 grand, and that's enough money just for them to get to maybe not series, or not a traction for Series A, or not enough traction. So what do you guys see, what's your guys' general thought on the Series A crunch that's happening, and sort of how to prevent against it as an early stage startup?
Well, just to answer that question, I think what you have to think about when you are starting the company and where you decide to draw your initial capital and what to do with it, you need to sort of plan out a roadmap, right? Before you ever take money from anyone, right? Whether it's your family, your friends, you need to at least have some kind of idea of where this is going to get you to, right? So if you think that you're going to start the company and 100,000 is probably going to be good enough, but you realize that you're not able to reach a certain level of milestones, you should not take that capital, right? So as an entrepreneur, you got to be really conscientious about how you plan not only the milestones you are able to achieve and what the capital is going to get there, because that's just really bad. And it's not saying that you shouldn't take the capital, but maybe what you do is you wait until you can get to the right set of milestones and the right set of capital. That's when you bring it in. I mean, the world is never that perfect, but you almost have to think of it from that perspective.
Sounds good.
Can you hear me? Oh, now
Yes.
you can. You guys were talking about the angel trend to start off the panel, about how much money we're seeing. Any reason to believe this will not continue, or slow down, or speed up? Thanks.
I don't have a great reason to think it won't continue because from where I sit, it's built momentum for probably 4 or 5 years. But you can say the same thing about the VC industry. Unless these same human beings that are putting in this money have some fun over the next 5 years and make some money, I guess it'll go down. But you're only now getting to this period because look, if this all really kicked up, I'd say 3 or 4 years ago, and you can ask that to Ron Conway in the next section, or whenever we're doing that, he'd be a great guy to ask. But this really all kicked into gear in the last few years. So if people are patient, they're doing the seeds, the A's happen, now, last year, next year. It'll be a while until these folks figure out if they're making money or not. Honestly, just like us. I mean, the fund at Walden that Pandora just came out of, we invested in that company in 03, 04 when it was teeny, $1.5 million pre. Only now are we figuring out we made a lot of money in it, which is great. So I don't think this is going to suddenly fall off the edge of a cliff unless the economy does. I think you're going to see pretty robust angel funding for a while. And those dynamics you heard from the panel about cheaper and cheaper to build a company to an A, I don't think 100 grand gets you there, but I think $500,000 gets you there pretty far. I think that's going to be true for a little while. Just my opinion.
I have one last question. That's actually for me. I've never heard this question being asked, and maybe it's because people may not be comfortable asking it, but I am. How do you guys feel about moonlighting? And when people are moonlighting and raising money, do you think they should be, kind of in the startup full time? Or do you think, what are your thoughts on that when someone comes to you and is moonlighting in a company?
Yeah, I'll take
Not
a
that I
shot
am.
at this. You have an idea you're working on? It's actually fairly common. There are people who have jobs at big companies who've been working on a startup in their nights and weekends. The only issue I think that really matters for a potential investment is whether the employer has any claim on the work that's been done, which is not uncommon at large companies, invention assignment policies, et cetera. So people who are moonlighting either show that they haven't done that, they haven't violated any of that, or they've gotten a written exclusion. Their manager, their bosses know they're working on this. But it's not a fatal characteristic for us. We wouldn't invest if someone's already got a job and they've been working on a startup at night. I mean, to me, that shows they could have a lot of passion, and maybe their day job is highly relevant to the new startup.
Yeah, the one thing I would add to that is keep it very sterile, very compartmentalized from your job, right? So whatever you're doing, if it's in the evening, whatever you're developing, don't do it on your current work computer. Buy a new laptop. Do it on something else. That you just absolutely have to keep it squeaky clean. And then with regards to IP, almost you have to do the same thing, right? So that's a major important criteria that you have to think about.
Sounds good. Thank you so much.
Great, thank you.
Nice to meet you, Josh.
Hey,
Nice to see you.
Absolutely.
Thanks so much.
Thanks.
Pleasure. Yep.